this market is much more powerful than the stock market. First off, read this disclaimer carefully. We are going to look at fixed income, specifically the 7 to 10 year Treasury bonds. Here's the distance from the 52-week low and the 52-week highs. Specifically, we will look at the iShares 7 to 10 year Treasury bond ETF. Let's first look a bit at the seasonality. We are currently in June, right here, June. And here you can see the percentage of months in which it closed higher than it opened. During this period, June was actually a relatively strong month, but July was rather weak. After 2007, you see that things have changed. June is now weak, but July is very strong. After 2011, you can see that, this of course is more recent, June is a very weak month for this ETF. And here is the most recent development. You can see that, compared to the adjacent months, June is weak. Let's look at the charts. Okay, this is more of the longer term picture. These are weekly data points. You can see here that the recent move for this ETF was rather aggressive. Very aggressive indeed, a huge move. There is some bearish divergence here on the RSI. You can see that RSI was higher here than it is here. That's a bit of an issue. And you can see that historically this one has regular pullbacks. It moves in these cycles. And you could make a strong case that this rising cycle has been a bit too much. But let's look, a bit at more data. Okay, so let's look at some trend analysis. Something that is quite interesting, daily data points, is that we were above these two key moving averages, the 20 and the 50-day moving average. We have now broken below it, okay? We do not have a firm super breakdown yet, but we are so close to having just a totally confirmed breakdown from this entire channel. That would be bearish for the IEF. Okay, so let's go further. Let's look at some money flow. Okay. Here you can see that if you look at the accumulation distribution line, you can see that while we were shuffling sideways, there certainly was some buying fatigue. But if you look at the most recent developments, there has been an increase of buyers. That is also reflected here in the Chilkin money flow. Let's look at the momentum indicators. If you look here at the RSI, you see that there is a clear descending trend, and we have started to peak below the Bollinger Bands, and you can see here that if you look further back, way further back actually, the Bollinger Bands are very tight historically. They usually are wider, and the problem with this is that we are building up energy. Hence, when you do get a move after the band becomes this tight, it usually is pretty significant. And so far, it certainly looks like the big move could be in favor of the bears. But this is definitively one to have on your radar. And you can see that the CTM and the PPO, it has been deteriorated consistently throughout this consolidation. Okay, let's also look at some relative strength. This is comparing it against the S&P 500, the mid caps and the small caps. And you can see here that during this phase, it was strengthening against the stock markets. But there has recently been some clear weakening. But within this time frame, it is outperforming the stock market. Let's look at some other indicators while we are at it. Yeah, let's look at these. This has a very like cool military style. And these indicators basically corroborate what we have already seen here. Let's actually look at, yeah, I think that electric blue is quite interesting. Because here you get the volume bars here, and you can see, at which price levels there's been more or less volume, and you can see that in this zone here there's been tons of volume, but below that level there is this vacuum, meaning if we do get some significant pullback here, we might go all the way down here, even potentially here, to find support. Okay, that would be the more extreme outcomes, but it just shows you how there is this real vacuum, and that can, so there can be some real fireworks here. Now let's talk quickly about how you can compare different kinds of bonds, because one of the key things is something called default risk, and this is where there's a big difference. The risk is rated by S&P and Moody's, and government bonds, they have significantly lower default risk than, say, corporate bonds. And in the corporate bond category, you have the difference between investment grade and junk bonds. So credit quality and time to maturity largely determine a bond's coupon rate, and the bond issuers with low credit rating must pay higher interest to attract investors. Hence, many of the junk bonds, they can seem really attractive because there's you get some very decent interest, but there's a very good reason why they need to put so much on the table. Some bonds can be redeemed prior to maturity date, and you also have the ability in some instances to exchange your bonds for stocks. Time to maturity varies widely, and more interest rate and inflation risks with time. The thing about being a bondholder is that you have more of a VIP status than the stockholders. And if you, as an example, have interest in Apple, you think Apple is a very interesting company, then you could of course own the stock, but there's many different kinds of Apple bonds that you can own, and by holding the bonds, you do have a higher ranking. I think that especially if you are very interested in dividend investing, then you should definitively look at the bond market, and also look at credit strategies when it comes to the options market, because they will really scratch that itch in many instances much better than dividend stocks will. Okay, let's quickly look at this ETF. You can see that the expense ratio is very cheap, 0.15%. The assets under management is huge, $21 billion US, very deep liquidity. And as we can see here, options are available and it is shortable. 1.74% dividend. Here is some performance data. So if we go a bit further down, you can see that 100% United States. There are some of the major bonds. You can see some of the rates here, allocation. So to sum up, we have now had a breakdown. There is this huge volume vacuum. Hence, the bears, they have a very significant opportunity here to pull off a big move. Of course, it is fully possible that the bulls will become desperate and pull off something big to save this. But at this juncture right here, it is quite clear that the bears have made a power move that could be beneficial if you are a short seller. Okay, let's now look at the S&P 500. to get the pulse of the market, we have this situation in which the S&P 500, it continues to climb quite strongly at that. If we look at the Joker, which I think is quite fitting in this instance. Let's go to the daily data points. For all intents and purposes, the bulls are in control. They just are. This move is very excessive, it doesn't make any sense, except for the fact that the central banks are extremely accommodative. Hence, the mutual fund managers and other fund managers, they can tell their clients that the central banks have their back and that they can just buy hand over fist with almost no risk. Of course, that is a very dangerous thing, very dangerous philosophy. There is this gap here that I talked about yesterday, that there is of course some possibility that we are going to fill that gap. But yeah, I mean it is just a pretty spectacular market, to put it mildly. Extreme crash, extreme rally. Clearly, the market is very divorced from realities. Long term, that never works out. It's important to bear in mind that there have been many different kinds of economic systems, civilizations, and monetary systems throughout human history. And it is very common for those systems to expand and then collapse. That is the norm. And I think there are very significant pathologies in the current system. We are seeing increasing social unrest, and think about it. Given that we have this massive social unrest, which goes beyond race, many people, they focus a lot on the racial angle. Sure, there is a racial angle here, but the economy recently just collapsed. There is unparalleled unemployment. Those are obviously factors that are contributing to this unrest. And if we do get continued rallies in the stock markets, meaning that the most wealthy people become more wealthy, do you think that is going to decrease social unrest or increase? Obviously, that will increase it. There will be a bigger divergence, and the Occupy Wall Street movement that we saw before, it will be peanuts compared to what is coming down the road if this divergence continues. As such, the stock market is between a rock and a hard place. If we do see a breakdown, then that will be uncomfortable, but there is also massive risks with new all-time highs because of what is happening with the economy. And there are many politicians now that are on the fringe. You see this fringe politics on the right, but you also see it on the left. I mean, you literally have politicians now on the left advocating in favor of attacking the police, in favor of riots. That is very radical. There's also politicians that think that one should seize money from the wealthy. That has been done many times throughout history. It never works out. The only thing that works is to have a united society, meaning you systematically work to have a holistic incentive system that, basically you want a system that offers the greatest good for the greatest number of all people. Whatever you do, of course, let the trend be your friend and be super careful.